Okay, well, on this video we're going to go through the financial info that Steve sent us for Whitney Manor, the profit and loss, and also rent rolls. And then after that we'll just do a quick brief run through of some deal analysis, and then in the next video we'll give Steve a call back and soften him up a bit for a low offer. So first of all though, let's just look at what he sent us. We've got the balance sheet here. Not really that much to look at. A few $1,000s in the checking account, security deposits, and liabilities. $3,000, and you know, that's interesting. The thing we're really interested in is the profit and loss. So we see the current income is $11,951 for the month of September, and we've got the expenses as they've been laid out here. Nothing really looks out of the ordinary. I think with a fully occupied property would probably have a few more in there, but they seem to be laid out pretty well and done by an accountant, property manager. The thing to note down here though is, not unexpectedly, there's a negative. So in the month of September they lost $6,764.38. Let's have a look at the rent roll. This is the rent roll sent through. This is for the 1 bedrooms, and just got the basic breakdown here: square feet, name of the occupants, lease charges. This is what they would like to get, I guess, their conception of market rents for these units. Lease charges, gross possible, actual potential. I don't know what they mean by actual potential, because actual and potential are like opposites. They're anathema to each other. So anyway, it seems, whatever, based on the language that they're using here, lease charges, this is what they're actually getting from the tenants. Gross possible, this is what they're advertising the units for. This is what they're actually getting. Further over here, there's more information on the rent roll. The move-in date, move-out date, how long the lease is, security deposit, whether they've paid deposit or not. Looks like there's quite a few people who haven't paid security deposit. Balance owed. It's like there's a few people behind on the rent. But as he said, I mean, given the damages and the fire and everything that's currently wrong with the property, it's kind of surprising there's anyone there at all. But for the people that are there, this is the situation with them. It's not a really high quality tenant mix, but here they are. For the purposes of buying this property, we'd anticipate turning over those tenants anyway. Maybe not. You never know what's going to happen. For the ones that are currently here, what we're basically looking for is just to know what the actual numbers are. What are the actual numbers of tenants in the property, the actual numbers of vacant units. So they have that pretty well laid out here. So we'll just get to the bottom of the rent roll, and see, so the total rent. Okay, so the total rent for the month was $13,041. Okay, so we've got occupied units 35, vacant units 61, and 36.46 versus 63.54. Okay, well that was interesting to go over those, just to get the factual information and the actual picture of what's actually going on with the property at this point in time over the last month, 2 months. So what we'll do now is we'll just go over a brief deal analysis so we can get an idea of what the property is going to be worth after all the work's done and it's been stabilized. And then we'll go through just a brief run through of the Mayo formula to see what would be able to possibly pay for the property, assuming all of the information that we've come across so far is going to be accurate. So first of all, I'm just using the word processor here to lay the information out rather than use a property information sheet, which just for recording on the screen it's going to be a little inconvenient. So I've just laid out the basic information here so we can go through it a little more easily. So we have the property name, units, number of units, address, their asking price, their cost per unit, property class C, the owner is a lender versus an individual. And this is the unit mix and rent based on the executive summary info that we got from the broker, along with his representation that came from the rent survey from the Apartment Owners Association of Memphis. So we'll use those for now. So number of units, the bedrooms and bath, square footage, the rent for each unit size, configuration, and the total of each comes to $43,064 per month. Multiplied by 12 gives us $516,768 annually. So that's our gross scheduled income. GSI of $516,768, and given that Steve told us in his last conversation with us, he mentioned this submarket had 95% occupancy rates. We'll take that with a grain of salt. What's in his executive summary here is that according to his figures, the vacancy rate for the area is 12%. So we're going to go with 12%. So subtract 12% of 516.78 is 62,012. Taking that away, the vacancy factor gives us a net rental income of 454,756, and expenses 45% of the GSI comes to 232,546. So taking the expenses away from the net rental income gives us 222,210. Steve represented to us that his idea of market rent was 8.5%, so we'll use that to get our NOI. We'll use that as our market rent to divide into our NOI. So the NOI of 222,210 divided by 8.5% gives us a stabilized value of 2,614,235. So this is going to be our future retail value that we use, what the property is going to be worth after it's been turned around, fixed up, repaired, leased up, and is operating at its peak level of performance. This is what the value will be. So this being our starting value and us working back, the multiplier I'm going to use here is 0.6. You may find other numbers for this. I've seen people use 0.65, 0.7. I want to use 0.6 because my whole premise for wholesaling is I don't want to offer anyone an average deal. I don't want anyone to have to think about it when they see the deal and they run the numbers and then something happens in their head. I want the thing that happens in their head to be this explosion of endorphins and pleasure and excitement when they realize, wow, this is an amazing deal. Because what this 0.6 represents 60%. That represents when the buyer, the apartment operator that we sell to, puts money out to buy the property, including paying us our assignment fee, and then all of the money that they put in for repairs after they've put out all of the money that they've got to put out in order to turn the property around and stabilize the property to produce this value that we have here. I want their cost basis, I want their total basis in the property to be no more than 60%. Because when they realize that they've got this cushion of 40% of the value of the property sitting above what they've got invested in the property, and that's a very safe position for them to be in. It's an easy decision for them to make. So we take our stabilized value of 2,614,235. We multiply that by 0.6, 60%, brings us down to 1,568,541. We take away the repairs of 760,000, which is, it's not the number of vacant units from the executive summary. It's the number of vacant units that we learned were there from the rent roll. So we took those numbers, multiplied them by the repair estimates from the executive summary, and I just added on another 25% cushion on top of that to take into account Murphy's Law and everything that does go wrong, that can go wrong when contractors start work. So that came to a total of 760,000. We take that away, we're left with 808,541. We factor in our assignment fee, in this case of $100,000, and that leaves us with $708,541. So we might come in the high 600s, 673, 694, something like that. And yeah, that's low, but this is also a property that it's got a lot wrong with it. And for that amount of money being put out in repairs, that's a lot of risk for the operator, for the investor. To have that amount of money out for so long, and let's face it, it's going to be 12, 18, 24 months before all of the work's done and all of the lease up has been completed, and the investor finally gets the opportunity to refinance the property and only then get that money back. That represents risk, so that risk has to be accounted for and compensated. The only way that can be done is through low price. So, you know, the seller may laugh at this offer, he may throw the offer back in our face, Steve may laugh at us, Steve may say, you got to be out of your mind, you're kidding. Well, that's great, they can do that and they can say that. I would much rather have someone laugh at us or throw the offer back at us and say there's no way, than pay too much and be in a property like this, having paid too much. That's just not a situation that I would want to promote to another investor, and it's not the kind of business that I like to do as a wholesaler. I want my buyers, as soon as they see the numbers, as soon as they do a quick calculation in their head, I want their heart to start pumping. I want them to be excited, and I want them to race towards the phone, to call me back, call their partners, to take the deal off the market. So I think with a price in this area, I think we'll have something like that. The next step though is to call Steve, and I just want to throw a bit more dirt on the property, on the situation, to make him, you know, backpedal and get him on the back foot, make him feel a bit insecure about his offering, so that the price gets a soft landing when we finally send it in. So we'll do that on the next video, and we'll talk to you on the next video then.